Hi guys, and welcome back to the videos. In today's video, we're talking about ways you can decide how much to invest in a startup, in angel investing. When you find a really, company that piques your interest and you think, oh, this is interesting. How do you actually decide how much you're going to invest? I've got a model that I try to use, and I'm going to go through that in this video. So let's get stuck in. So the first things first, I would think about how much you're going to invest. Try not to do it too emotionally. And what I do is think about percentage of my budget after, also making sure that you've got everything else sorted and emergency funds. Hopefully you own a residential property already and you've got some shares, etc. I wouldn't go to angel investing first. Circle of competence. Do you know about the industry? Do you have experience? Have you invested in other companies in that industry? How have they done? The team. How good are the team? I think this really does, it's hard, but I do notice when there is a good team. What do I mean by a good team? Years of experience. Have they exited other investments before? Have they grown businesses before? Have they worked in big companies and small companies? Do they have a board of advisors or a non-exec board where they can actually draw upon certain expertise? Having people that have had that expertise of growing a company does make a big difference. Like how about that's gone from 20,000 users to 2 million has someone quite senior or had someone quite senior from Snapchat, and a company that I'm interested in investing, Caldi, has got someone, which is a fintech, has got someone that's grown the large fintech bank called Tide. He was the CMO there for a year or two. So I think having people like that have gravitas, that have the experience, that have been through that journey makes a difference in terms of team. What's the fourth thing? The fourth thing is the potential of the idea. Is it an idea which is different? Does it actually add something to what's already in the market? Can it be copied easily? So what's the strength of the actual idea? It's also important to think about FANG. Are Facebook, Amazon, Netflix, Google, etc. Are those companies, are they going to copy the idea? Can they copy the idea? Or indeed, if it's in the fintech world, can a bank easily copy the idea? What about the size of opportunity? This is sometimes called the TAM or the SAM, the target addressable market and the serviceable addressable market, meaning what's the actual size of the market? If it's a B2C fintech, it's anybody. Everybody saves, or everybody earns, so they can all have a bank account and they can also transfer money and they can save money. And in theory, everyone can invest something, even if it's just £10 a week or whatever, $10 a week. So it's interesting to think about that potential, that TAM and SAM, and they're often in investor decks as well. But you don't need somebody else to tell you this. You can also do some analysis yourself and thinking about how big is the idea. And it's easy to think, to delude oneself to think that, everybody's going to be interested in this new app. But think about it realistically. Who are the target market and how likely are they to buy this product or service? It's really important to have that realistic, pragmatic view. And also going back to the circle of competence, how have you seen other companies grow fast? Like with me, I've seen Moneybox grow fantastically in the fintech space and Revolut and Monzo. So I can see Caldi, this fintech. I'm not saying it's definitely going to explode. I'm talking in February 2023 here. It might not, but it does have some of these things. So I did want to talk about this in relation to a company. And Moneybox is one of those that has grown fantastically, 10x in a couple of years. And I think it is, the industry, it's important to pick an industry that's growing. The next is speed to market and speed to scale. How quickly can they actually grow? I've invested in companies that have found it difficult to grow, and in some cases, a couple have gone bust. Even if the idea I thought was amazing, even if they thought that the size of the opportunity was massive, the team was great, the product was great, everything was great, but they couldn't scale it fast enough. And investors lost patience and they stopped basically investing and backing the company, and the company went bust. This was a really fantastic robotics firm. It raised 13 million and it still went bust. It was called the Small Robot Company. So speed to market and speed to scale is important. Now, sometimes it's hard to define or understand how quick it is to scale. Fortunately, I've got a growth marketing background, so I understand what companies have the opportunity or the ability to scale, especially, when I've seen it with other companies, or I've marketed, with fintech. I've worked for fintechs, I've worked for banks. I kind of know how easy it is to scale a hot fintech. So that's what, I look at, one of the sectors I look at. So speed to market is important, speed to scale is important. Growth levers. What do I mean by growth levers? Growth levers is anything a small company can double down on and go into that's going to really expand the users, the revenue of the company. Literally, what can they pull to grow the company? It might be paid media, it might be advertising, it might be referrals, it might be partnerships, it could be a whole range of things. It could be going international, it could be through acquisition, acquiring other businesses. There's a bunch of different growth levers, but what are the growth levers of the company you're thinking about, and how much do they rely on raising funds? What I mean by that is like paid media growth, advertising growth relies quite a lot on raising funds. But if they have no organic growth, that is a bit of a risk factor. Like I invested in How About, it's one of my biggest holdings. It's a social media app that has its growth is 90% organic and word of mouth. When you have something like that, it's going to grow even if they don't raise any capital. It's going to keep growing and growing and growing. Moneybox, again, that grows pretty organically as well. They do have a lot of ads, but you want to try to find companies that have some level of like organic growth, whether it's referrals, whether it's word of mouth, whatever. Like that's always good. And if they haven't got that, how easily are they raising money? How much are they dependent on a very large investor? Even if they're raising millions on on an investment platform, you have to be a bit careful, because as soon as one of the big investors stops investing, maybe they can't actually fund their operations and they go bust. So in this kind of market that we're in, things have changed since 2020, 2021, when I started investing and there was money flowing everywhere. There's less invested capital, and people are, VCs and private equity and big investors are investing less. So you have to be wary about that. And that's why it's important to think about what's happening. Can a conversation expand the business? For some of the B2B companies I'm looking at and investing in, packaging, for example, sustainable packaging, like they have a conversation with a big retailer and the retailer's interested. Like the product speaks for itself. That is a growth lever. If you have a fantastic product that basically sells itself, you just need to have a conversation. That's a growth lever, and it's one that doesn't require advertising, doesn't require lots of spend. CAC, cost of acquiring a customer, it's kind of related to growth levers. It's important to think about the cost of acquiring a customer in relation to how much money the company has and is likely to have in the future. Caldi, for example, thinks they can is basically acquiring people for £3, £3, and they think they're going to get revenue of between £50 and £100 per customer. So that is huge. It's amazing, and that's what you want. You want small CAC, small cost of acquiring a customer, and you want large revenues. And that leads me to the next thing: annually recurring revenue. Can you invest in a company that is kind of basically generating revenues and cash flow on a continual basis without like needing to go hard on sales or keep advertising? Maybe hopefully it doesn't have a lot of churn. Like Moneybox is a fintech app where people invest in it every year. They're using it as their savings and investment app, which means they're never going to leave the app, which means the company has a lot of annually recurring revenue. Same with something like a Monzo or Revolut. People join the bank, they're not going to leave the bank. They're going to keep using that. I'm sorry I'm using fintech, but like most of my investments at the moment are in fintech. I do invest in other things. There's a UK company called Oddbox, which is a food delivery company. I've invested in that, but even myself as a user, I've gone on and off it. It's not as sticky. So that's where annually recurring revenue, stickiness, customer churn, these are metrics you want to look at and consider. The next thing is the flow of investor funds, the velocity of the funds, how quickly it comes, how reliable the funds are, and how much people are raising. Like essentially, sustainable packaging isn't raising as much money as fintech. So that means the products and services in sustainable companies and in like what I'm talking about in packaging, plastic removals and things like that, like they're just not raising like millions and millions. I think the last time Moneybox raised, they raised 6 million in 2 days, £6 million. That's like, I don't know, $8 to $10 million in 2 days. It's incredible. So think about the velocity, the speed of which a company will raise money, and the reliability. That means that if they ever need to raise capital, they can just come back to the market and they can just raise money like that. It's so important. That can be basically the decision between whether the company goes bust or not. Meat This Farm, a huge plant-based company, one of the biggest in the world, it was worth 200 or 300 million. It went bust because a big investor pulled out and they couldn't raise the funds fast enough. So that's important. Industry pizzazz, is there sparkle about the industry? Like I said, vegan foods, like it's going down. Like it's not particularly, there's not as much interest in it. Sustainability and eco is not as hot as fintech. So it's interesting to think there are cycles within industries and within the funds raised within that industry. And that's something to be aware of. There are kind of, robotics, I think at the moment in 2023 is on the down scale. It's kind of early for robotics. I got into robotics in quite a big way. I've got about 20% of my overall fund in robotics. Some of the ones that like are reliant on outside key investors have gone bust. But I've invested in some that are like almost incubators in VCs. I've got a couple there, which I'm hoping are going to keep going because I've got quite a bit invested. But like I said, there's cycles of industries, and you want to try and get on the upswing, and you want to try and get into an industry which is keeps on growing, and there isn't kind of a lack of investor confidence in it, like there has been a little bit in the robotics industry with Zoom Pizza going under, and a few others. Ideally, you want to have the next thing is you want to have an existing large company that's raised a lot of capital and grown through the cycle already. That's a kind of existing use case or footprints that another smaller company can follow in. Like in the fintech world, Monzo and Revolut have gone up to 10, 20, 30 billion dollar valuations. So the companies like Moneybox and Caldi and a few others, Plum, like these guys can grow into multi-billion pound dollar companies. That's really helpful. I'm not saying it's a prerequisite, but in the minds of retail investors and VCs and people that are going to back it, like Series A, B, C, etc., there's a well-trodden path. So I do think that's important. The next thing to consider, going back to it, is about you. How much money, disposable income that you can afford to potentially lose, will you invest at different stages? Like I've found Caldi, and it's only valued at 8 million. It's a very risky time to invest in a pre-revenue company. Moneybox, I think the first time I invested was at maybe 50 million or 100 million pound valuation. But I was saying to myself, I would have loved to invest in Moneybox when it was only valued at 20 million. So it depends on your personal risk appetite. And also, if you invest heavily at an early stage, do you then follow on? A lot of these companies will raise once a year or once every 2 years. You see, you have to think about that. So it's almost like a percentage of your budget. Let's say you have a £10,000 a year budget for small scale investing. If you're a bigger investor, you can times it by 10 or 20 or 100 or whatever. But I'm going to assume that most people are investing between 10, 20K a year in angel investments. Yes, there'll be some out there that are doing more. But for argument's sake, how many companies are you going to want to invest in? In terms of my own experience in 2020, 2021, 2022, I invested in loads. I invested in about 90 companies. And in 2023, it was only 5 companies. And I think in this year, I'm really only looking at very exciting companies. And that's number one. And number two, in follow-on rounds. And number three, I'm actually looking at secondary markets as well, where you can buy shares on a secondary market for lower than the price of the previous raise. So that's an interesting way to think about it. So going back to the original question that I just asked you guys, how much would you invest early stage versus the follow-on? So what you can actually do is divide your desired total amount in this company. Let's say you got a company X. In this case, for me, it's the fintech Caldi. It's valued at 8 million, and they're raising now, and they may raise again in a year or two. And there's probably going to be 3 or 4 rounds, but there could only be 2 rounds. So let's assume, kind of prepare for the worst. So let's assume that like most companies will have 2 to 3 rounds. Let's say they only have 2. What I would do is then, a few days ago, I was thinking about Caldi that I'd only put in like 5%, less than 5%, to probably going to break it down into 2 or 3 rounds. So if they are successful and they keep growing, I'll put more and more in. So I'll probably end up putting about 3 to 5% in the early stage of Caldi. And the next thing to think about is how okay are you with things going south? And that's where we think about something called asymmetric investing. What that means is, what's the likely upside of the investment? In this case, let's think about Caldi for a moment. Like Moneybox is valued at like around 200 million, I think, at the moment, and Caldi is valued at 8 million. Moneybox has 1 million users, and Caldi is generating 5,000 users a month at the moment with not that much money raised. Their initial goal is 100,000 users, and I think they're going to generate about £100 per user. So I personally think that they could quite comfortably get to £100 million valuation. I think it's quite likely. So when we think about asymmetric risk, what's the upside? I think they're quite likely to get to 100 million. If they're valued at 8 million now with like 5,000 users, within a year they might have 100,000 users, and then within 2 years maybe 200,000 or 300,000 users, and they're going to be generating revenue and hopefully within 3 years profit. So it's kind of thinking about your risk return. I think that the somewhat likely scenario, I think it's about 50-50 that Caldi gets to 100 million, which is a 12x increase on its current valuation. And I think there's a 50-50 chance that it doesn't succeed in some way and goes south. Maybe it's less than 50%. I actually think it's more like 20%. that it goes bust, and maybe 30% that like it doesn't do as well as expected and takes longer. Um, but overall, I think there's a low chance of it going bust purely because of all the things I've mentioned. It's an area I understand it's got a great team with the tied people, the opportunity is large, they have lots of growth levers, low CAC, good annual recurring revenue. There's a massive investor funds going into fintech. So yeah, so it's in terms of what you're doing and you're investing. One thing to think about is the expected risk return ratio, which it's always in my mind best to go when you think about angel investing with the asymmetric risk model, which is in my mind the things that you're investing in need to return at least 10x, or at least have the chance of returning 10x. Obviously, not everything's going to be a 10xer. In terms of my 100 investments, it looks to me like I've got about 4 or 5 of the companies so far that are going to achieve over 10x. Moneybox is one of them. How about another? There's a few in the sustainable packaging spaces as well, and there's a few others. But anyway, if you don't do that, most people are not going to invest in 100 angel investments, but they might invest in 10. But let's say you want to invest in 10 angel investments, and each one is only likely to achieve a potential 3x return. But typically in angel investing, it's like 1 in 10 companies does well. So let's say because you've got a small sample size of only 10 angel investments, there's a chance that none of them do well. They all go bust, or maybe one does well, but it only 3x's. If you've put the same amount of money in the 10 companies, you've lost, over 2/3 of your entire portfolio. That's really significant. That's why it's really important to think about when you're investing in companies, how likely is it going to be to more than 10x, to 10x or more? And that's another reason why I've invested in 100 companies. I would prefer to invest in 100 companies and have a smaller investment size and invest at an earlier stage, because there's a much more likely chance that the company is going to more than 10x. Oddbox has already 30x'd. Now, I didn't invest in it early, but it has 30x'd. And I didn't get any. There are other examples of companies that I've done more than 10x. So I hope that you found this interesting. Just a quick recap: percentage of budget and earnings that you can afford after an emergency fund, after you bought a residential property and ideally some other asset classes like stocks, within your circle of competence, ideally, within having a good team and even a board of advisors, everyone with experience, ideally, with a good idea potential, good size of opportunity, big target addressable market, good serviceable addressable market, good speed to market, their ability to actually launch quickly and scale, highly likely or probabilistic growth levers that they can pull, low CAC or cost of acquiring a customer, ideally an amazing product or service which people like to talk about, or it's sold within a conversation or a message or a link, good annually recurring revenue, fast flow of investor funds, industry pizzazz, an existing large startup that's grown to be a unicorn. And then to think about your personal circumstance, divide it by how much you'd invest in the early stages and follow-on rounds, and think about your overall portfolio as well. I hope you found this useful. This is just my way of doing things. This is not advice. I'm not a financial advisor. This is just kind of my way of deciding how I invest in a startup. And there are other factors. There are obviously the context. Are you working, not working? Do you have considerable free cash flow that's reliable? Are there dips and ebbs in your cash flow, etc.? Like in 2023, when I was laid off from WhatsApp, I just couldn't afford to invest thousands in angel investments. So I went down to hundreds in each one. And I didn't invest in many. As I said, I think it was only 5 or 6 last year in 2023. We're in 2024 at the time of recording. And I'm looking to follow on some of these companies. Some of the companies have done really well, and I want to keep backing them. So it's important to think about your circumstances, present and future, and to invest accordingly. Never invest in knowing or thinking that everything's going to work out. You have to expect that some angel investments will not work out. They'll either go bust or they'll take ages to do well. You just have to have a reasonable, rational, logical mind about this, that these things take time. But they compound. I invested in Moneybox in 2020, I think, when it had 200,000 users. It's got 1 million now. I wouldn't be surprised if by 2030 it's got 2 or 3 or 4 million users, and it's valued in the billions. And that could easily be a 20 to 30x return. That's my largest holding. So that'll pay back the funds and more. Should that do as I expect, and that's just one of the 100 that I've invested in. So it is a long game. That's a 10-year, potentially 10-year return. But that's how you have to think about it. I think 5 to 15 years is the best time frame to think about. Anyway, I'm going on to different topics. I hope you've enjoyed this video. Like and subscribe. Remember that knowledge is power, especially like kind of knowledge, and progress is everything. Maybe you might be interested in some of these other videos. Consider liking, subscribing, and sharing with friends and family. I'll see you guys in the next upcoming video. Take care.